Hey guys, Brian Davis here from Spark Rental. Super glad to have you with us. And I'm really excited to have Josh Cantwell with us. Josh is the founder and CEO of freelandventures.com, a real estate syndicator who has invested in over 4,500 units. Josh, welcome to the show.
Hey, Brian. Thanks for having me on, man. Good to connect with you again. It was great to have you on our show. And I'm happy to share with your audience. Thanks for having me on.
Absolutely. Well, I'm excited to have you on and to talk about multifamily investing in particular, since that is an area of expertise for you. And we were talking on your show actually about risks in multifamily investing. Ways to mitigate those risks. Some of the risks that you see in the multifamily investing market right now. And I would love to just start right there because that's obviously a concern for both new and experienced passive investors in real estate syndications and multifamily. So let's start there. Tell us, first of all, about what risks you see in today's market moving forward and how you guys are preparing for or mitigating some of those risks.
Sure. Look, I think the entire syndication world fell in love with buying essentially at retail price with low cost of debt in high growth markets, primarily in the Sun Belt. And if that was your strategy in 2020, 2021, 2022, then if you look at the adjustment in cap rates going up, values going down, it's like, okay, well, now a lot of people have said, well, I'm going to get out of the market. I'm going to stop investing because values have gone down. That seems backwards to me.
Totally
Because
backwards.
cap rates are up and values are down. That means you can actually get a better deal today,
Yeah.
right? And so interest rates become part of the topic to see whether those deals can be financed and cash flow. But purely from a risk perspective of price, I actually think it was more risky to buy properties in 2020 and 2021 than it is today. Because today we're getting back to fundamentals. And some of the ways that we eliminate risk is, number one, what I like to do is pencil my deals. I have kind of a specific day and time that I want to get to, which is 42 months. I have about 500 investors. We've raised over $100 million. And I know if I can get my investors out of the deal through a sale or a refi in roughly 3.5 to 4 years, they're going to be unbelievably happy with that investment. They don't really want to be in deals for 7 years, especially if they're non-accredited. They don't want to be in for 7 years, 10 years or longer. They kind of want to cycle their money and create multiple streams of income. So in order to reduce risk and get out of these deals quickly, we have to buy them and be all in at roughly 70% of its future value. Well, how do you really jack up and raise up that value by 30% in less than 4 years? The answer is buying, in my case, buying medium or deep value add deals. Value add is the most overused term in the entire business because they're like, we're going to take our black appliances, we're going to convert them to stainless steel, and that's value add. Well, that's
Right.
not value add. Value add to me is, like, give you an example, Brian. We bought a 28 unit 60 days ago. It was in foreclosure receivership. And we knew that it was in trouble for about 3 years, but with the former owner being in foreclosure receivership. And so when we bought it, we had the strategy to basically non-renew all of the residents. Okay. And some people would say, well, you'll have no cash flow. That was by design. Okay. And so now as we sit here, we're basically 75 days from the date we bought it. And out of those 28 units, we've full turned 21 of the 28 units.
Oh, wow.
And in the next 30 days to 45 days, we'll have moved out and turned the remaining 7. And so within 90 to 120 days, we'll have completely renovated the entire building, including all the commons, all the lighting, all the paint, all the flooring, all the LED lights, every unit. Every unit will have new LVP floor, butcher block countertops, white shaker cabinets, stainless steel appliances. And so you can tell me, is that more or less risk than buying something in the Sun Belt where you're hoping that there's development, appreciation, and jobs that move into that town. And you hope that 5 to 7 years later, values are higher. So the way that we manage risk is by managing this construction program for us. We've hung our hat on construction, and we believe that by bringing in a 35-year commercial construction vice president and all of his connections and all of his subs and laborers, and then really dying in our supply chain and getting access to lines of credit and really standing up a construction program that only invests and only does our deals. We don't do it for clients. It just does it for us. We've mitigated a tremendous amount of risk because we can faster turn buildings, faster turn units, quicker hit our pro formas and projections, manage the supply chain, move out bad residents, and move people in. So we're not just an operator, we're what I call a hyper operator. I invest in my backyard. It's another way that we reduce risk. We invest locally in our backyard, even though it's not the highest growth market in the world. We're in Cleveland, Ohio.
I
So
was
those
just
are
going to
just a
ask where
few
you guys
things.
were. Yeah.
A few things, Brian, that we really do. We buy medium to deeper value add. We own the construction company. We force the appreciation inside of 42 months to hit our pro formas. And I invest in my backyard. Those are things I think a lot of syndicators didn't do in 2020 and 2019, 21, 22. They were investing virtually in some other market without a construction company, hoping for appreciation versus the value add stuff that we do. So those are some real examples.
No, that makes perfect sense. And, I totally agree that now is a less risky time to invest in real estate syndications than a year ago, 2 years ago, 3 years ago, when everyone was super pumped up about syndications because they were selling for such enormous profits. Of course, now everyone's wringing their hands and worrying about interest rate risks and, what if interest rates go up more? The time to worry about interest rates, I think, was 2 years ago when no one was talking about that risk, right? When they were super, super low and everyone just assumed that they would stay low forever. So I would love to hear your thoughts on some of the risks that no one's talking about right now, but they really should be. And I'll give you an example. I've heard a couple operators talk about how they've seen insurance premiums rise very dramatically over the last year as sort of a hidden and unexpected risk and expense that no one has really been talking about, right? And maybe now people are starting to a little bit. But what are some of the things like that you see as risks that not enough people are talking about in this space?
Sure. I think there's a couple specifics that I can give you on our portfolio. One is the cost of water and sewer bills are going up 15% per year for the next 3 to 4 years. Okay, that's been from our local water and sewer department has said these are going to be the rate increases. They're totally uncontrollable. There's nothing we could do about them. So even when we did a low flow water program a couple years ago, we thought that the water and sewer bills would go down. They did, but now they're going to inch back up. So that's a risk for sure that we're going to see. Second thing for sure is insurance. No question about it. Insurance is going up everywhere. I think one of the big risks, Brian, is that what if interest rates stay high for the next 5 years? The Federal Reserve has raised rates so fast, so quickly, but our economy seems unbelievably resilient. There's still tremendous amount of jobs coming online. We're still not seeing a recession, although we're getting closer. That GDP keeps going down a little bit. It's going to be a mild technical recession, and I think our economy is going to take back off. And when it does, I think that interest rates could stay high for a long time. The forward curve has interest rates going down at the end of 2024, about a year from now. Well, what if they don't? What if those interest rates, are staying at 6% for permanent financing? Well, then your cap rate has to be a higher spread over and above your interest rate. And guys that penciled their cap rates at 4 or 5 are not going to be exiting their cap rates at a 7, 6.5, 7. And so that's a risk, is that interest rates stay high for the long haul. So if they can't sell, how can people recapitalize? right? That's going to be a big question for a lot of investors that bought is, their loan to values might stay down and maybe their values are going up. So their loan to values are staying low, but their investors are going to want to get out at some point. And so if those investors can't get out, it creates a risk for them to stay in the deal long term. Their cash on cash returns go down. And so those investors might want out, and those syndicators and operators are going to have to find ways to recapitalize. So I think the answer, look, is he who has access to the investors, the access to money, is always going to have the lowest amount of risk. So risks that you might not think about is when you do come up on that balloon scenario, you come up on the end of a loan term. Everyone's like, I want to sell, I got to sell, I got to sell. Well, not really. There's a lot of investors that would be happy to get out, and new investors get in and recapitalize a deal. And so I still think it comes down to investor relationships. To me, that's 100% the backbone of our business. It's the most important thing.
Well, that makes total sense because interest rate risk, as you said, it affects exit cap rate, right? If interest rates are high, that's going to drive up cap rates, make it a lot less profitable to sell. But it also makes it more difficult to refi, right? So, you're kind of stuck between the rock and the hard place of,
It
do I
makes it
sell at a
difficult to
high?
refi at a high loan to value, right? You can refi at a lower loan to value, bring in new debt, maybe get rid of your floater rate loan, bring in a permanent loan at, let's say, 6%, but you only might get 55 to 65% leverage. So then it comes back to what investors can I bring into that deal to recapitalize it? That's what I mean about those investor relationships. I think a lot of guys haven't done a lot of transactions in the last year, so they've let their investor relationships kind of suffer and kind of fall to the wayside. I think they should be doing the opposite. They should be creating more content, developing more relationships with more investors, and especially if they're going to need to recap their deal.
Right. So yeah, no, I love that you're talking about that third option, right? You've got the rock and the hard place of, sell at a high exit cap rate or refinance at a really high interest rate, and my cash flow will suffer. Or here's the third option. Here's the creative solution of, I'm going to let some of my investors out of the deal and raise new capital to replace them and to avoid having to refi at a very, very high LTV at a super high interest rate. Which goes to show that there's always a third way.
It's a good message because you're like, look, we've operated the real estate. We've driven the value. We've pushed our value add program. We're getting close to our pro formas on our rents. I don't have any control over the Federal Reserve. I don't have any control over the 10-year Treasury or the 5-year Treasury. So that part of our program hasn't worked out the way we thought, but that's totally, nobody could have forecasted that stuff. And so but the operator did their job. And so it's a really easy message to tell. We did our job. We operated the real estate. This one thing with interest rates didn't work in our favor. So we're going to recap the deal, and we're going to get some new debt at a lower amount. We're going to bring in new investors at a 6 pref or an 8 pref or a 5 pref or whatever works, because we want to own the real estate. Don't just bail on the real estate, right? There's the third option, like you talked about.
So, Josh, you have done some talks in the past about your 7 commandments for multifamily investing. And, we don't have a ton of time left, but I would love to just have a quick overview of what you see as those 7 commandments of successful and profitable multifamily investing.
Absolutely. Here we go. Number 1, you got to be all in at 70% of its future value. 70% of its future value. Number 2, you want to be able to return investors' capital in 3 to 4 years max, not 7. Number 3, invest for immediate cash flow. Make sure the deal spits off immediate cash flow, and hopefully enough cash flow that investors can get at least a 6% preferred return. Number 4, always invest with an experienced operator. If you have a inexperienced operator, make sure it's a smaller building, right? Risk reward, right? So if it's a smaller, newer operator, make sure it's a smaller, less risky building. Number 5, we love to invest in our backyard. I live in the Cleveland area, so we invest in Cleveland and Columbus. When COVID hit, we had deals in Mobile, Alabama. We had deals in Houston, Texas, Lawton, Oklahoma, Albany, Georgia, Macon, Georgia, and Ohio. When COVID hit, we decided to bring everything close to home. We sold off a lot of the older stuff in those other areas that we couldn't visit every day. So number 5 is invest in your backyard. But if you can't invest in your backyard, focus on the Midwest. I like the Southeast as well. The South, although it's super high growth markets, some of that stuff is going to slow down because of the cost of interest rates. Number 6, make sure you plan is that you can refinance and keep equity in perpetuity. Okay. The idea of cash flow is unbelievably critical. Cash flow with equity is unbelievably critical. Turning buildings makes sense to turn the money. But so even if you buy a building and you're going to sell it, make sure you 1031 exchange those monies and move from a C class to a B or a B class to an A so that you can keep your equity moving. Don't fall in love. I want to get to this. This is actually the bonus, so I'm not going to say that yet. Number 7, make sure you have multiple exit strategies. Don't just buy it to do a value add program and sell it. You don't get wealthy long-term flipping real estate. You get wealthy from cash flow. That's where it comes from. And number 8, the bonus commandment, right? The bonus investment strategy is don't fall in love with the asset, fall in love with the equity. And if you need to move the equity from one investment to another, do a 1031 exchange, sell and buy. Do that. There's a lot of people right now that have equity in their buildings and they're married to keeping their old building because they bought it, they love it, they want to see it through to the end. Sometimes it makes sense to move the equity to another deal. Prices have come down. So you can move that equity to a deal that has a lower basis, a lower price, which means you'll probably get more cash flow than in the existing deal that you have. Okay, so 70% of future value, return investor equity in 4 years or less, immediate cash flow experience, operator, invest in your backyard, get equity in perpetuity, have multiple exit strategies, and fall in love with the equity, not the asset.
I love those. And I love how quickly you managed to go through those without skimping on them too much. I think we got the message for each one, and it's perfect. I do have a follow-up question for you before we wrap up. You mentioned doing 1031 exchanges. I actually haven't seen any sponsors offered deals that are designed for 1031 exchanges to non-accredited investors, but I understand that you work with non-accredited investors. All your deals are 506B. So do you design some of these deals as 1031 exchange deals from the very beginning and make those available to non-accredited investors?
We always want to make that an option, right? I believe that as a sponsor, my job is to listen to the marketplace and then create programs, investments, products that investors want, that the consumer wants. And so the answer is yes. We go into deals always thinking, can we bring in 1031 tick dollars? Or when we exit the deal, can we exit them with the intention of doing 1031 exchange? So that's always part of the conversation every single time, even for non-accredited, because we feel like if people are going to exit the deal, what do they really want to do with the money? They just want to create more cash flow. They just want to get a better return. They want to make another good investment decision. And if they can move from our deal to another one of our deals, and it's a better way to use the equity, that's what we're going to do. So we're absolutely structuring deals for both 1031 coming in and 1031 going out.
I love it. Josh, where can people learn more about you and Freeland Ventures? How can they connect with you if they want to invest with you guys?
Absolutely. Just our main website, freelandventures.com. There you'll see the tabs across the top, and you can see our portfolio, access to our podcast, as well as being able to register on our investor portal. I've created like 700 videos on our YouTube channel. We've had 500 episodes of our podcast. It's amazing content. And there you can also join our investor list, see our portfolio as well. So freelandventures.com.
Well, I'm super excited to check out some of the deals that you guys are doing, and maybe we can invest in some of those deals in our co-investing club. So Josh, thank you so much for joining us today. This was a lot of fun.
Awesome, Brian. Thanks for having me on.
Absolutely. So guys, please, if you enjoy these conversations that we have, rate, review the podcast on iTunes or wherever else you listen to podcasts. Keep in touch with us. Let us know what kind of conversations you want to hear from us in the future. Email us, support@sparkrental.com, and we will catch you on the flip side.